Hello guys, this is YouTube channel Path and Lighter, and this video is on insurance for APFC exam EPFO conducted by UPSC, and this is presented by me, Deepak Jaiswal. I'm Inspector Customs in 2006, ranked 161 APFC 2012, and joined as APFC Ahmedabad in 2004 or 2014, from which I later resigned. Now, introduction to insurance. Insurance is a practice or arrangement by which company or government agency provides a guarantee of compensation for specified loss, damage, illness, or death in return for a payment of a premium. In short, it can be said that it is for providing protection against a possible eventuality. Insurance is a form of risk management primarily used to hedge against the risk of a contingent or uncertain loss. Equitable transfer of the risk of a loss from one entity to another in exchange of payment, which is called as premium. Now, insurance governing acts. There are 4 insurance governing acts. The first is the Insurance Act 1938. The second is LIC Act 1956. Third is Marine Insurance Act 1963. And fourth is General Insurance Business Act 1972. Now, types of insurance. There are 4 types of insurance. First type is personal or life insurance, and this further is divided into 2 parts. First is term plan, in which the money will be given to you only when you die, to your relatives or to your nominee. And the second is endowment plan. In this plan, if you die, the money will be given to your nominee, and if you survive, you will be given your installment back with some premium or some bonus. Second is property insurance done by property, liability insurance for loan, guarantee insurance when someone takes guarantee. Then there must be written contract. The term of insurance is there must be written contract between 2 parties. That is, insurer and insured should have a valid offer, acceptance and consideration. Now, the types of insurance. There are one insurance is double insurance. What is double insurance? Double insurance, the same risk and same subject is insured by the policy holder. Same risk and same subject is insured by the policy holder. The loss will be shared by all the insurers. Each insurer is directly liable to the policy holder, and it is a method of assuring the benefit of insurance. Second is reinsurance. Reinsurance is the insurance of the insurer. In short, that is the transfer of part of the risk by the insurer. The reinsurer will be liable for a proportion of part of insurer. The law will be liable for a proportion of part of insurer. The reinsurer is liable only to the first insurer. It is a method of reducing of the risk of the insurer. Now, business model of insurance. Transaction involves the insured assuming a guaranteed and known relatively small loss in the form of payment to the insurer, that is premium, in exchange for the insurer's promise to compensate, that is indemnity, and the insured in the case of a financial loss or personal loss. Insurance involves pulling funds from many insured entities known as exposures to pay for the losses that some may incur. So the business of insurance is taking premium from many and giving it to some who have incurred losses. The insured entities are therefore protected from risk for a fee, with the fee being dependent upon the frequency and severity of the event occurring. Insurance as a financial intermediary is a commercial enterprise and a major part of the financial services industry. But individual entities can also self-insure through saving money for possible future losses. Now, terminology in insurance sector. Indemnity. The insurance company indemnifies or compensates. The compensation is known as indemnity. The insured in the case of certain losses only up to the insured's interest. Now, insurable interest. What is insurable interest? The insured typically must directly suffer from the loss. Insurable interest must exist whether property insurance or insurance on a person is involved. The concept requires that the insured have a stake in the loss or damage to the life or property insured. Utmost good faith. The insured and the insurer are bound by a good faith bond of honesty and fairness. Material facts must be disclosed. Now contribution. Insurers which have similar obligations to the insured contribute in the indemnification according to some method. Subrogation. The insurance company acquires legal rights to pursue recoveries on behalf of the insured. The cause of loss must be covered under the insuring agreement of the policy and the dominant cause must not be excluded. Mitigation. In case of any loss or casualty, the asset owner must attempt to keep loss to a minimum as if the asset was not insured. Co-insurance. Risks shared between insurers. Dual insurance. Risks having two or more policies with same coverage. Self-insurance. Situation where risk is not transferred to insurance companies and solely retained by the entities or individual themselves. Reinsurance, we have seen already that situations when insurer passes some part of or all risk to another insurer called reinsurer. Underwriting, the process by which insurers select the risks to insure and decide how much in premiums to charge for accepting those risks by investing the premiums they collect from insured parties. The most complicated aspect of the insurance business is the actuarial science of rate making of policies, which uses statistics and probability to approximate the rate of future claims based on a given risk. Actuarial science is a science which deals with how much premium to be paid for how much amount. These are the persons who, on the basis of risk involved and other things taking into factor, decides the premium. Insurance business is heavily based on this actuarial science. Now, social insurance. Social insurance is a collection of insurance coverages including components of life insurance, disability income insurance, unemployment insurance, health insurance and others, plus retirement savings that require participation by all citizens. By forcing everyone in society to be a policy holder and pay premiums, it ensures that everyone can become a claimant when or if he or she needs to. Insurance companies may be, this should not be here. Insurance company may be classified into two groups: life insurance companies, non-life insurance companies. Life insurance companies which sells life insurance, annuities and pension products. Non-life or property or casualty insurance company which sell other types of insurance. Now, insurance in India. Listed in the Constitution of India in the 7th schedule as a union list subject. This insurance is listed in union list. Now, India allowed private companies in insurance sector in 2000, setting a limit on FDI to 26%, which was increased to 49% in 2014. So at now, 49% limit is there. First insurance company in India was Oriental Life Insurance Company, which was started by Anita Bhavsar in Calcutta to cater to the needs of European community. Oldest existing insurance company in India, which is still now existed, is the National Insurance Company, which was founded in 1906. Now coming to LIC of India. On 19 January 1956, nationalizing the life insurance sector, LIC came into existence by absorbing 154 Indian, 16 non-Indian insurance and also 75 provident societies. In total, 245 Indian and foreign insurers in all are amalgamated to form LIC. In 1972, with the General Insurance Business Nationalization Act, general insurance business was nationalized with effect from 1973. In this, 107 insurers were amalgamated and grouped into 4 companies. First is NIC Limited, National Insurance Company Limited. Second is New India Insurance Company Limited. Third is Oriental Insurance Company Limited. And fourth is United India Insurance Company Limited. The General Insurance Corporation of India was incorporated as a company in 1971 and it commenced business on 1st January 1973. Before late 90s, the industry consisted of only 2 state insurers, LIC and GIC. GIC had 4 subsidiary companies we have already seen. With effect from December 2000, these subsidiaries have been de-linked from the parent company and were set up as independent insurance companies like Oriental Insurance Company Limited, New India Insurance Company Limited, National Insurance Company Limited and United India Insurance Company Limited. Now, Insurance Acts in India. Insurance Act 1938 is to govern all forms of insurance and to provide strict control over insurance business. IRDA Act 1999 to provide for the establishment of an authority to protect the interest of the holder of insurance policy, to regulate, promote and ensure orderly growth of insurance industry and for matter connected therewith or incidental thereto, and future to amend the Insurance Act 19 and further to amend the Insurance Act 1938, the LIC Act 1956 and the GIC Business Nationalization Act 1972. The Actuaries Act 2006 is an act to provide for regulating and developing the profession of actuaries and for matters connected therewith or incidental thereto. Now IRDAI, Insurance Regulatory and Development Authority of India, is a regulatory and development authority under Government of India in order to protect the interests of the policyholders and to regulate, promote and ensure orderly growth of the insurance industry. As per the Section 4 of IRDAI Act 1999, IRDAI, which was constituted by an Act of Parliament, specified the composition of authority. Therefore, IRDAI is a 10-member body consisting of Chairman T.S. Vijayan, 5 all-time members and 4 part-time members. All members are appointed by the Government of India. Now, there is a term called bank assurance. A question was also asked in 2012 regarding what is bank insurance. Bank insurance is basically a bank insurance model. This means bank selling insurance, distribution of insurance products by banks. Insurance products are offered through the distribution channels of the banking services along with a complete range of banking and investment products and services. For banks, it is a win-win situation for all the three parties, insurance sector, bank sector and public. See how. For banks, it just acts as a mean of product diversification and additional fee income. For insurance company, it acts as a tool for increasing their market penetration and premium turnover. And for customer enjoys greater access to all financial services from a bank that offers both banking and insurance products, which is resulting in cheaper insurance products. This is all it. Subscribe to this channel for free education. Promote it among friends. For any queries, mail it to pathandlighter@gmail.com. Thank you.